Well, this is Michael Douville here in beautiful sunny Scottsdale, Arizona, and quite honestly, it just truly is beautiful here. I need to get some disclaimers going. You know that I am not a licensed stock and bond broker, nor am I a licensed financial planner. I do an awful lot of investment work here in Arizona. We have a lot of properties, and that's my specialty. Although I'm reasonably well versed in an awful lot of the other asset classes. I'd like to talk about them a little bit. I've had a couple of warnings that I've been going on over and over and over again. It seems like the economy is slowing reasonably quick for a big economy. It's coming down. The Atlanta Fed just came out and said that the third quarter was 1.5% GDP growth. 1.5 is pretty slim, pretty not too much. 2% is kind of almost stall speed. We're gotten down to 1.5%. That's pretty tough. And of course, they generally like to look at that through rose-colored glasses as well. And oftentimes, you know how these economic numbers a year from now they'll say, "Oh yeah, we were significantly different." I just don't see any growth. I don't see any growth anywhere. Dallas came out and said that Dallas Fed came out and said that their growth has dropped as well. All the federal Fed districts in the United States are showing decline. So, it's slowing pretty drastically. It's been going on. If you look at the Economic Cycle Research Institute, I mean they're in the news all the time. They've been showing that 2015 that the economy has just slowed from the first, and it just continues to slow. So eventually you're going to have profit problems, and you're going to have employment problems. I just saw that employment for the first time in like 9 or 10 months has actually declined. So my concern is this: we've been having this debate for quite a while. And I think that there's problems around the world. We did a video not too long ago with Walter Zimmerman. Walter Zimmerman, of course, is a energy and commodities analyst, and he's a pretty sharp guy. He forecast in 2013, when oil prices were in the 90s, that we would be looking at $37 oil. It got down to 37.75, so I would say it was a pretty doggone good call. Now, he also says that commodities aren't going to recover till next year. And you can see that Glencore, who's a big mining concern, they have bonds to finance all their acquisitions. Well, gosh, their stocks and their bonds are just taking it on the chin. They're closing mines around the world. And if they don't recover till 2016, that means that you don't need their commodities. And you don't need their commodities because the economy is bad. If the economy is bad, there's no profits, there's no employment, things start slowing down. And this is not something to be afraid of. This happens all the time. I think this is the sixth or seventh slowdown or recession I've been in my lifetime, in my career. I mean, this is to be expected. You have more expansion than you do recession. So these things are happening. You just need to watch the tea leaves and just see what's going on. Now, could it be a false recession? Of course it can. I don't see anything on the horizon. You can see that China's slowing down. You can see Europe is in terrible shape. So until we start getting some sparks that say, oh yes, these things are starting to improve, odds are that they're going to continue down. And this is just the way it happens with the recession. It goes in, clears out all the malinvestment, and you start over. Generally, once you start over, business gets so much better. And this is just kind of what I think is going to happen. So I have been pounding the table a little bit to take your money out of the stock and bond market, just to shift your assets and just to do some asset preservation. Now, I'm telling you that I'm in the real estate business, but I'm also wanting to tell you that the correlation between direct ownership in real estate and Wall Street are pretty tenuous. There's not a whole lot of correlation. So if you have a panic on Wall Street, doesn't necessarily mean that you're going to have a panic in real estate assets as well. Real estate really is regional and local. Sometimes prices and desirability of properties can change in a one-block radius. So, and we're on a completely different cycle than the stock and bond market. Our cycle for the real estate business should peak sometime 2023, 2024. So this is 2015. We have a lot of time to grow wealth. Now, I do believe that we may have a correction. That's very, very common in marketplaces, as we generally on a 16 to 19 year cycle. 18 is what most gets quoted. So that takes us out into the early 2020s. So that gives us really a long time to do this. But it would be very, very common for us to have a correction. And a correction coming up soon would just correlate well with the stock and bond market having problems. And that's all I think we do is have a correction and an ongoing bull market. So I'm pleading with you to take off some money. It's prudent. It's just prudent. You've had really, really good results. Why would you, when it's risk, why would you just take some money off the table? Take your profits. Take more than your profits. I am basically in cash with mine, and I'm not all in real estate. We have some IRAs and 401ks. We have money in the stock market. I have a little short positions, but not too terribly much. And I would say, my advice is if you don't have much in real estate holdings, I would take whatever money that you're going to allocate, and here again, it's asset preservation and asset allocation. So I would take 25 to 35% of whatever money it is that you're going to allocate, and if you need to finance, and I'm going to say probably 70-80% of my clients generally do, and financing is really good because the money is so good at the moment. But if you need to finance, then I would purchase now, even though I think that you're going to get a little better pricing in a short period of time. But I'm concerned about financing. So when things get bad, financing goes away. So I would allocate the money I'm going to finance now and buy now and get things to the cash flow. That cash flow will help you if you have a downturn. You can go ahead and cushion it a little bit by generating some extra cash. And really, real estate is generating so much more cash than you would get at the bank or CDs or any really conservative bonds at the moment. So it would be beneficial to you in that regards. And then, of course, real estate, again, is a separate asset class. This would be wealth preservation, would be to get the money out of a class that's at risk and into one that is less at risk. And real estate at this point, of course, there's risk in every asset that you could possibly have. But it's certainly manageable. And if we get a good cash flow, cash flow cushion whatever downturn that you have, and we'll just ride it out and ride it into the oncoming bull market. Then when things start to get a little bit of turmoil, that's when we buy. When things look really bad, that's when you get a call from me saying, it's time to deploy the capital. And everybody goes, oh, no, I'm not going to do that. But really, it's really the best time in the world for you to do that. And when no one else wants to buy, that's when we as investors want to buy. That's when we make our best buy. I think you're going to get a buying opportunity. But I think financing will be very difficult at that time, so I'm concerned about interest rates, which leads me to bonds. I think bonds are at risk as well. People say, well, it's a bond. But you have sovereign wealth around the world having problems. You see sovereign nations, sovereign bonds having problems. I mean, look at these big nations like Brazil and Argentina. France is having problems. Spain, Greece. How can you leave your money with in these sovereign wealth funds? It just doesn't make sense. It's not prudent. At some time it takes a lot of profit to make up for loss. And at this point, I wouldn't do that. So even if you let it sit in cash, and I think you're probably okay with the cash, some very, very short-term U.S. Treasuries, some inverse ETFs might be pretty good. But I would want you to get into some growth real estate. There's several growth markets around the country. We're here in Phoenix, absolutely blessed with very, very good properties. I mean, this is, as real estate investors, this is like the place to be. So we're really, really happy that we're here. You can do it yourself. We would certainly love your business. We can acquire the property. We can lease it. We can manage it. We can repair it. We can do whatever you want for us, and hold your hand, wherever you want us to fit in, we'll certainly do that for you. You're welcome to call. We're here to help you. You're welcome to call me. I'll be more than happy to talk to you. I'll talk to your financial advisor. I'll talk to your significant other. You can come and meet me. We can go over and see what will work best for you. But I think we have a big bull market coming, and I think you can participate in it. But I would really, really be concerned about the stock and bond market because I think the economy is starting to slow pretty significantly. So listen, it is an absolutely stunning place to live here in Scottsdale, Arizona. It's about 75 degrees. There's not a cloud in the sky. It is as blue as you could possibly be. The golf courses are open. The hiking trails are open. So come out and see us. We'll see you. Bye-bye now.